This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. My name is Keith Ford. I'm your host for today, joined as always by my co-host Aaron Dunn from Smarter SMSF. How are we, Aaron?
Very well, Keith. Yourself?
I'm doing very well, very well.
It's been a busy week. So I think this time last week we went to air and the exposure draft, so the draft legislation on what is now referred to as Div 296 had just been released. So it has been a pretty hectic week. The industry has been frantically getting its head around what it all means. So I guess we're probably going to start with that today.
Your guess is correct. We are definitely going to be starting there. In our previous episode, we said that people wouldn't hear from us until the consultation was effectively over. But instead, we are actually going to come and give people an extra episode. And for the next few weeks, we will be moving to a weekly schedule for the podcast. So people get to hear more of your insights every week instead of having to wait a full two, which is lovely for them. But we'll jump into the news that's all about the $3 million super cap. We've got a smorgasbord of information, the most recent of which coming just on Wednesday morning, which was from the International Centre for Financial Services. It's at the University of Adelaide, and this research was commissioned by the SMSF Association. It's all basically around the $3 million super tax and how it's going to impact SMSF members and the tax liabilities they're likely to face on this. The headline number is that 50,000 SMSF members could be negatively impacted by the change, with the liability exceeding $80,000. That's the mean additional tax liability, would have been over $80,000 in 2020, 2021 and 2021, 2022. So that's what people can look forward to in a couple of years' time. What are your thoughts, Aaron?
Well, my thoughts are that it's great that as an industry, we can come together to put this information together fairly quickly. So the reality is that the SMSF Association, together with a number of software organisations in our industry, have been able to work with the University of Adelaide and identify quite quickly, from a sample size, mind you, of 2/3 of the SMSF industry, right? So we've got 720-odd thousand members in this sample size, and we know that the sector is 1.1 million members, roughly. So we're working with actual numbers here, and quite clearly we can see the amount of impact that would have simply looking at data from the last couple of years. Now, we know that that figure is going to grow. We know because we're A, looking at historical data, and B, $3 million on 1 July 2025 is probably about $2.8 million today, if we really think about it. So did those numbers use the $3 million benchmark? Did it use a slightly lower benchmark? Because we know what inflation is going to do to $3 million by the time we hit the 25, 26 year. So for me, I think, A, it's great that the industry has been able to identify this pretty quickly, identify the quantum of the impact. And then the real interesting thing is the fact that the research highlights the real liquidity challenge that's going to exist as a result of the taxing of unrealized gains here. The fact that we have, I think the number was around 13-odd%, if I'm not mistaken, that was talking about, was in asset concentration that was then going to create liquidity issues. Interestingly, the government has flagged that as an issue, and I don't know whether you want to use the word looked upon it favourably, but in essence, they've given 84 days to pay the liability, which is a bit longer than most things. And they've actually given a concessional general interest charge if it's not paid on time due to those liquidity issues. So rather than it being 7% above the bank bill rate, it's actually only 3% above the bank bill rate. So there's a 4% interest benefit through this legislation. And I think all that is just acknowledging that we are going to confront some pretty significant liquidity issues based upon the current legislative framework that the government's looking to move forward on.
Yes, and you just about bang on with the number there. It's around 13.5% of affected SMSF members essentially are expected to experience liquidity stress, is how they framed it, which is, I mean, look, it's better than, having all of the people that are affected facing liquidity stress, but 13.5% of those 50,000, it's not a small number. That's a considerable amount of people each year when they're having to pay their tax that are going to be having to look at whether they need to liquidate an asset, whether they are able to find some other way that they can scrounge it from somewhere to pay this debt. It does bring in a real lot of issues and the idea of the taxing of unrealized gains. And this is the whole point that a lot of people were calling out before it even got to the draft legislation stage.
Yeah, the other thing that I found quite interesting in the research that was done is that they obviously recognise that this is taxing of unrealised gains is extremely rare as a tax position, in particular in OECD economies and pension systems. But also it kind of says, well, if you took out the unrealised gains concept here, long term, their view was that the taxing of realised gains when it occurs is probably going to end up being a better budgetary outcome. So this is not an argument to say we don't feel like there should be an additional tax. This is saying we get the lay of the land as an industry. You want to introduce it. Let's just fix the mechanism because the unrealised taxing of gains here is not a fair outcome. But this research is saying is long term, you might not actually end up with the best result. Yes, you might not get the real, people might not sell assets right now, but they're going to have to sell assets. Like people will die. The assets need to leave the superannuation system, or they might get sold in the superannuation system. So they will get caught as income at a future point in time. And then therefore, at that point in time, the Div 296 tax should apply to it rather than trying to do it on a annual basis where you're simply looking at a movement, and some of that movement is going to be subjective where it is either determined based upon a valuer, if we're looking at real estate, if you're trying to value unlisted assets where there might not be ready markets, all those things that are naturally going to blow up, I think, in the coming years.
It does, I suppose, bring in that idea where if you're being forced to sell an asset in order to cover the liability, that you could be selling at an inopportune time. You're taking the choice away from the member and then forcing them to essentially to sell something in a market that perhaps wouldn't make any sense for them to do otherwise, which now obviously this is something that comes up whenever someone has bills. They may have to sell an asset that they don't necessarily want to. It's not like it's unique to this situation, but it is one where the government essentially is putting that onus on people to have to do it.
Yeah, and a lot of these people that are advised won't be waiting until this law comes in before they make decisions. Like they are on the go already saying, I have just over 18 months, 20 months to get my affairs in order. And they're talking already to advisors, accountants and so forth and saying, well, I'm not waiting for this. I'm going to make the necessary move. Obviously, we need to wait until it becomes LAW, not LORE, as it's kind of the case at the moment. But as soon as that comes into play, you're going to be seeing the advice process really kick in and say, well, look, are you going to be better holding it here? Or are you going to be better maybe paying a little bit of tax now and moving that asset into a trust, into a company, into your own name, into someone else's name? Because they go, we don't want to end up in a situation whereby we've got this unrealized capital gain rubbish, because that's in essence, it's an unfair way of actually taxing this, and saying, there's a different way we're going to do it. Because if I hold it in my own name, and I know the SMSF Association recently came out with an example of this that showed that the tax position in a particular year would end up being higher than the marginal tax rate, highest marginal tax rate.
Right, yes. And so we can probably pivot to a different section of the $3 million super tax, which is something that someone you'll be very familiar with, Tim Miller, who is, of course, a member of the Smarter SMSF team. He told SMSF Adviser about the possibility of a double tax, which is not a term that anyone likes to hear. It's essentially being applied a way that within the draft exposure legislation that it could be applied to excess non-concessional contributions. Could you give us a little bit of a run through on how this all works?
Yeah, so ultimately this comes back to the way that the calculation's working, and when we look at the Div 296 requirements around what withdrawals. So when we think about the adjustments for withdrawals and contributions, it's kind of looking at almost like the debits and credits that we have within a transfer balance account. So you've got to make adjustments or add back withdrawals and deduct off contributions. And what it says is it talks about the amount of a payment made during the year by a fund from an interest of yours in relation to a release authority would need to be included in the withdrawal. So if you've got an excess non-concessional contribution, which shouldn't be in the system anyway, and then you're forced to take it out, and then you're actually required to include it or add it back in the withdrawals calculation, in essence, it's getting double counted. So there are these type of things that will be flagged as part of the consultation process to go, well, is that really a fair and reasonable outcome for the taxpayer here, whereby the law mandates the removal of this money and there's a mechanism that deals with an earnings on the period of time which is in the fund, and then you're requiring to add it back in the calculation for the purposes of Div 296? Doesn't make sense.
You've gotten very good in a short period of time at remembering to call it Div 296.
Yeah.
I don't think I've done it once at all over the last week. I've got to add it to my, throw it into the repertoire, into my vocabulary.
In the SMSF industry, there are so many acronyms and stuff to be dealing with. So Div 296 is the easiest way. We know Div 293, quite interesting. Div 293 to Div 296 is an increase of 3, which is equal to the $3 million. So it's quite easy to remember that if you're a nerd like me.
That's the way you've done your shorthand to figure it out.
Yes, correct.
So on the other side, we do have someone who's saying that it's not all bad news. Meg Heffron, who is the director of Heffron, aptly named company, she said that while within the legislation there's obviously issues, but she's pointed out a couple of areas where she thinks that not everything is all bad. So what are your thoughts on some of her ideas?
Yeah, well, Meg's a half glass full person, a good friend of mine.
Good to have some of them in the industry, you know?
Correct. Yeah, but I guess what Meg has highlighted here is we sometimes do need to look for the positive in the negative, and ultimately, what Meg has highlighted here is that when we've looked at this exposure draft, it has highlighted a couple of interesting things within the SMSF sector. So, for example, with the concept of total superannuation balance, the fact that with the TSB, we have limited recourse borrowing arrangements after 1 July 18 in certain circumstances get included, they have excluded those for the purpose of the calculation. Another really good example here is as a result of these measures, what they have decided to do is they've decided to simplify the concept of a total superannuation balance, and in particular around the retirement phase calculation and decoupling it from the transfer balance account, where we kind of did this convoluted calculation to come up with current value. So there are a couple of things through this that actually help and simplify. Yeah. So from that point of view, we can sort of look at some of these things in a positive light. They're not necessarily the things that we wanted, but we'll take what we can get at this point in time.
Take what you can get. That's right. It is always good to look on the bright side sometimes. So that kind of wraps up our big overview of the $3 million super tax. There we go. I've done it again. Div 296. I'm going to get there eventually. We've got to drill it in.
It's a tax.
So one of the other things we've got this week, we'll touch on one other topic. We can't have it all be about Div 296. Thank you. So something else that came out was that the SMSFA has essentially asked that, or called for a bit of clarity over asset and income tests. It's obviously something that is important to a lot of people within the SMSF industry. As with everything, we like clarity. It's something that It makes it much easier to do your jobs when you know what you're actually meant to be doing. So can you explain some of the ways that we can get some clarity from these issues?
Yeah, so what the SMSFA is really requesting here, and it's something that's not necessarily new to the industry because we've seen over time with different reviews and so forth, and here we have a government review around the regulatory framework for managed investment schemes, is this issue of, is a self-managed super fund a wholesale client or captured within the sophisticated investor rules? And therefore trying to understand whether when we look at SMSFs, it's captured under the $10 million professional investor test for funds, or are we looking at the $2.5 million asset test? And there is a level of ambiguity in the rules without any formal guidance. And there has been requests for that guidance for a long period of time. And this topic, as I said from the beginning, has been highlighted and then commented on in a multitude of reviews since it was, I guess, originally stated in 2001 in the future, since it was legislated and then being raised back in the future of advice reforms in 2011. But we don't really have clarity around this, and therefore whether an advisor talking to a client needs to be relying on the $2.5 million test or the $10 million test for the purposes of investing makes it very muddy for people to work around, and therefore getting absolute clarity on that and then framing up what it should look like going forward. Because those thresholds, in essence, haven't moved for a long period of time, and clients who may not ever have been caught by this legislation simply because of things like their house value having, breached $1 million or $2 million, plus with some superannuation, other assets and so forth, all of a sudden could fall into this when quite clearly their knowledge and level of financial sophistication does not fit this model. So there is a view that we need to look at this with some urgency. And this government review just provided another forum to highlight the importance of the government trying to look at this matter.
Yeah, and I know the Stockbrokers and Investment Advisors Association raised something similar with the house value, in the idea that because that has got particularly in Sydney, many other places around the country as well, but I believe they, in their submission to the consultation, specifically highlighted the Sydney market as well. Someone can correct me on that if I got that backwards. Yep. But because of that massive increase in house values, that way more people are going to be falling under the wholesale investor as wholesale clients when they really shouldn't be. And nothing else about them outside of that single asset is going to make sense for them to be wholesale.
Yep, absolutely.
So yeah, it's certainly not just the SMSF side of the industry that is worried about these wholesale tests either.
Yeah, the other thing that was raised in this was around the use of accountants' certificates. And I know across Accountants Daily and other publications with Momentum, these sort of things have been very topical. And I know we've seen the professional bodies within the accounting industries jointly come out and provide guidance to their professional members about these sort of issues. So again, the SMSFA has highlighted that in here to say we kind of got to end the use of certificates that, these product issuers and advisors are trying to rely upon more and more and more.
Yeah, absolutely. All right. Well, we're going to take a quick break now. When we come back, we'll have an interview with Raymond Hempstead, who is from Supavest, talking everything property within SMSFs. All right. We're joined now by Raymond Hempstead, who's the founder and managing director at Supavest, which was formerly known as One Contract Property. Nice to meet you, Raymond.
Keith, thanks for having me on board today.
Not a problem. Would you be able to, just before we get into the meaty questions, give us a bit of a rundown of Supavest and One Contract Property, as it was formerly known, and what you guys do?
Yeah, about 3 years ago, we started up One Contract Property to be able to give people that are looking to use their superannuation and get into property maximum choice across Australia. So being able to now build brand new properties inside their superannuation or using their SMSF.
Right. And so one of the issues there is when you're building a property, you have a land contract, you have a property contract, there becomes a bit of an issue when you're only allowed to have a single asset that you're investing in through the SMSF. And so that's the general idea, is you're trying to solve for that.
Yeah, like in the past, you have been able to find a single acquirable asset, or you've been able to get a builder that will build a property for you as a single asset. But that's very specific in where the builder will build, not necessarily where you, the investor, want to build.
Right.
So we remove the builder out of the picture as in the funding side, and we come up with the single acquirable asset through the one contract property solution, or the Supavest solution as it's now known.
Right. And so some of the different methods that people use in SMSF, they look for taxation strategies, the different incentives that are available through an SMSF, obviously having the different taxation levels between an individually owned asset versus one held in a superannuation fund. There's differences there. So how does Supavest go around assisting investors essentially to understand and take advantage of these incentives and with those brand new house and land builds?
So a lot of it is around the education, where if people are looking at buying property and holding it long term and looking after their retirement income, up until now, you haven't had the choice to build, in my opinion, the right type of property. High cash flow property is where you can get some great tax benefits and pick up the depreciation, but then also making money on top of the contributions that you're putting in. So now you can build that. And where people have been building it, they've been using unit trusts or family trusts or companies outside of superannuation, paying 30% tax. And when they get to retirement, they're still paying the tax. Where being able to do that same build inside an SMSF now, you're paying 15% tax during your working life, but then when you get to retirement, depending on a few tax changes that may be coming, you're now paying zero tax on that income and then zero capital gains on it as well. So it's some major benefits on that side.
Yes, and obviously slight allusion there to the $3 million super cap, which
absolutely
has very recently had the exposure draft legislation and things along those lines, which everyone will be talking about, and I'm sure for more than just the consultation period, for months and months, and right up until we find out what the final form of that will take. Is that something that I suppose these investors that are looking at property, is that something they need to be keeping an eye on? How much of a change do you think that will have?
It depends on your whole attitude and outlook. We're always going to be paying tax. And the government has got their eye on a $3.5 trillion industry, and they're always looking at ways of making money. But if you think about it, if you're building property and building your wealth in a super fund, in an SMSF, you're paying 15% tax during your working life. That's still better than a company or unit trust all the way through that. If you then get to retirement and you have got under $3 million worth of assets, you're still paying zero tax. If you've got more than $3 million worth of assets and being able to build the right type of properties, that's very, very practical these days, then you're paying tax of 15% on anything above that. So you're still in a much better position in retirement, whether they're taxing it as well.
It certainly does seem that way, where while there's many people that are quite concerned, and if you've already got more than $3 million in your super account, can't really blame you for being concerned. But yes, that idea that there's a good chance, and obviously individual circumstances dictate this, but there's a good chance it's still going to be more taxation friendly anyway.
It will be.
Yeah.
It will be.
So something that does come up, I suppose, with SMSFs is some of the limited choice in terms of the type of property that they can get into as an investment, and what's available through the Supavest offering, I suppose, is how I'd phrase that. Can you explain a little bit about that and the types of properties that people can get into?
Yeah. Up before Supavest, you could buy property in your superannuation with your self-managed super, but you're limited to established properties or properties that were going to be built by a builder under a single part contract or off the plan. Most of those properties aren't high cash flow. Right, if you think about it, if you're an investor outside of superannuation, you want to go into a property that's returning 11% return, you're going to be paying above the market for that property. Now, that's why a lot of people in self-managed super funds don't have access to those properties, because they're paying well above the market for them. What Supavest allows you to do now, you can actually build that property. You can build the high cash flow property, whether it's a co-living, dual key, NDIS property. You can do subdivisions of land. You can do everything that's going to create a lot of income. You can now build that inside your super fund. On the other side, you've been limited pre-Supavest to where you could buy or where you could build if you found a builder that was going to do it. With Supavest, you now can build inside your super fund exactly the same way you can outside of your super, because we're giving you total choice in the builders, the location, the styles, whatever you want to build with you and your advisors, you can now build in your super fund.
And I suppose when there's this general idea that many people go into an SMSF because of the choice and the flexibility that it gives them with how they can control their own retirement income and their retirement assets, it's a little ironic that you are so hamstrung on the property side of things.
Absolutely. And most people didn't realize it. In the SIS Act, it is to be able to give you that control or give that limitation, it is there to protect the investor and the self-managed super fund balance.
Right.
All right. So it is a protection mechanism, but in that protection, it's removing a whole lot of choice. And so with Supavest option, we actually give you back that choice while still having that protection on the asset as well.
And on that idea of choice, it does lead me to the next thing from Supavest, which is the safe property investment is what you call it, an acronym there, the SAFE. But the idea there is that first-time investors maybe don't have the cash available to put into the property asset. Obviously, property can be expensive, and it's almost fractional but not fractional investing. Can you explain how it works?
All right. This is an investment under tenants in common. So as an investor, if you want to be able to dabble into the property market and you haven't got $200,000 or $300,000, you've got $50,000 or $80,000, you can now buy a 5% share of a property, and we're building high cash flow properties. So you're actually on title. You're a landowner and your super fund is actually a landowner on title. And then you're getting up to an 11% return from that high cash flow property. So it gives you the ability to either, if you've got some additional funds that you want to dabble, you can now buy a small part of a property and be on title, or you can now have multiple small parts around Australia and diversify your investment across Australia, across different properties around Australia as well. So it gives you a lot of choice.
Right. And so you've used the word diversify there. Obviously, a diversified portfolio, that's what everyone kind of aims for. They want different asset classes. They want different exposures. When something's going bad, something else is going well, and it keeps you afloat, keeps you earning all the time. The idea of having it in different markets is pretty interesting as well, where you're diversifying your exposure, not just in the asset class, but also in the different markets. So if the Sydney property market is hot, which it always feels like it is, someone who lives in Sydney, that's, concerning. But it also then can help when another property market maybe is a little bit slow.
That's right. And it gives you the ability to be able to get into the market. If it's on a downward cycle, you can get in when it's low and follow the property trends. It also then, hey, I'll be honest, my bias is new property. That's what we promote.
Right.
All right. So understanding people have got biases, that's my bias. So being able to give people that choice, they can buy into a safe property, a single key. They can buy into a dual key. They can buy into an NDIS. They can buy into a co-living. And each of those can be in different states and different locations. So then you've got the diversification. It's in property, but it's, as you said, it's in different states. It's in different asset classes within property and gives people that comfort as well.
So you mentioned the NDIS properties there, which is the National Disability Insurance Scheme. You've got properties that you provide a way to invest in these properties through Supavest. How does that work?
All right. We play in that space very selectively. And what we do, we run what we call a participant-led model. We'll work with the SDA, the actual people that are managing the participants, to find out where they need the demand or where they need the housing. That gives us where the house needs to be built, and then we build the house and then find investors that are actually looking to build that. So that then provides accommodation for the disabled people across Australia. And the major benefit for that is you get some amazing returns from government funding that comes into that whole scheme.
Right. And then also helping to provide housing for people who will be struggling with different types of disabilities, I assume.
Without investors building these houses, these disabled people are in inappropriate accommodation. They're in group homes, they're in hospitals, they're in old people's homes where they shouldn't be. So this actually gives them quality of life back. And we call it a karma investment, because you're actually changing someone's life that hasn't got a choice, and you're also getting a very good return coming back.
Right. So certainly sounding win-win on that front.
Absolutely.
So something else that I suppose with property and superannuation that kind of just makes sense is that long-term idea. And so property, most people would look at as being a long-term investment because it is something that over time is almost guaranteed to appreciate in value. Certainly been that way historically, it's continued to increase. Superannuation is also very much a long-term investment. It's planning for your retirement. So having those working together, I suppose, makes a lot of sense. And it's important to understand how that kind of plays together, I guess.
It is. Now, if you look at anything you're investing should be able to support you in retirement. If you've got your asset class in something that's not producing a high level of income, when you get to retirement, you then have to dispose of that asset and then live off the capital. Where if you're now building the right type of property that are high cash flow properties and it gets paid off during your working life, so when you get to retirement, the asset is paid off, but it's still producing a high level of income, you're now receiving your lifestyle and your security from an asset that's continuing to increase in value, but it's also returning you cash flow that you can live on. And so that's something that hasn't really been available to a lot of investors in their self-managed super funds because they haven't been able to build or buy the right type of property to be able to support that.
Right. And so as you hit retirement age, those income-generating assets are certainly important. So trying to find an advisor that understands this, I'm sure, is probably something that's pretty important as well.
Very much. Like, there's a lot of advisors out there. We're taught to get financial advice, but understanding the biases that each person has got, like mine, as I said earlier, is building new property. That's my bias. The financial advisors, a lot of their biases, they can't talk about property. They're not licensed to talk about property. But even if you do find someone, you've got to understand, have they got an investment portfolio themselves? Do they understand property? Do they understand your dreams, goals and desires to be able to get there? And do they understand the power of Supavest in being able to provide the right type of property now inside your super? So you need to get advice, but how you get the advice from and who you get it from is really important.
Getting advice, obviously something that this show is in favour of everyone doing, particularly people who are in SMSFs because it is such a complex area. And so how would you see people that are wanting to get into investing, perhaps through Supavest yourself, how would they go about finding that right advisor and making sure that they're someone they want to work with?
They can reach out to our team or your team and we can put them in touch with advisors that do play in the property space. I suppose, as I said, I've got a bias in property. The advisors need to be able to talk about shares and properties and collectibles and the whole lot and understand that based on where you as an investor want to be able to end up. And so where that comes in, if they want to touch base with us at supervest.com, we can give them a list of people that they can go and talk to. And I think you'll be able to do the same thing from your listeners on your side as well.
We can certainly try. At the same time, many of our listeners are going to be those advisors. So perhaps it's somewhere that if they're not super comfortable in the property space, it might be something they can educate themselves on and look into and find different ways to help their clients, I guess.
Yeah, and with the advisors, we're talking to a lot of advisors. Supavest is a unique product because of what we do, and getting advisors comfortable with what we do and how they do it is something we spend a lot of time week on week doing while we're here talking with yourself, getting people aware that this is now possible and reaching out, asking the question so they can be better informed for their clients and how they can build the wealth for their clients as well.
Absolutely. And so where do you see property within SMSF going? Is it moving towards that fractional? And obviously your version of it is not the same as many other forms of fractional investing, but is it moving towards that way of doing things? Is it perhaps outright property within SMSFs? How do you see that moving?
I believe when people understand the power of what they're doing, it'll be outright ownership. The fractional side will come in because there's always going to be additional funds that are left over, and people that love property, they love property. They want to be able to keep their money in good property. So there's a range of people that we're talking to that will be using the safe property across several different states and be able to diversify that way. But the outright ownership is still the key, because if you think about it, we can put $27,500 maximum into our superannuation through our wage. But if you can now get into and build a property that's putting $50,000 or $60,000 a year on top of that into your superannuation from cash flow positive rental returns, you can now accelerate your superannuation and your wealth creation within your superannuation because you maintain a very good asset. So I believe it's going to be more and more full property purchases, and then with the remainder, people have then got the choice to be able to put into a safe property where they're getting up to 11% return on that side of it.
Wonderful. Well, thank you very much for joining us today, Raymond. There's a lot there that I'm sure the listeners will have been very interested in hearing about. And thank you for joining the show.
Keith, appreciate your time, and thank you to your listeners.
Not a problem. All right, we're back now with Aaron Dunn to wrap up the news of the week. Aaron, I'm sure that it's probably going to be Div 296 related.
Yeah, well, you can't get away from it. I think it's kind of bombarded the inbox. It's been part of literally every conversation that you've been having. It's obviously significant. We've spoken previously about the lack of time frame to consult. So as an industry, we're kind of feverishly working through these things. So it's good to see that the SMSF Association was armed with, some of that research to push back, and hopefully some of that actually can cut through, I think is probably the right thing, at least when we see it introduced into Parliament, in particular the Senate, and others are listening. I think I saw the Nationals last week actually really flag this as an issue. David Littleproud. So he indicated that because quite clearly that electorate around farmers and those that have quite heavy asset concentration through commercial real estate, then that naturally includes farmland and so forth, are going to be heavily impacted by these rules. So yeah, that Div 296 is certainly front and centre right now and will be right through to the end of this year, no doubt, and potentially as we move into 24.
That's right. And it pointing out where there are shortfalls and things that need to change. It is the entire point of these consultations, and highlights why there maybe should have been more than 2 weeks.
Correct. Yeah. And the reality is up until this date, we haven't really seen the government feel like they've taken a lot of feedback on board. So there is a level of cynicism, just how much they might take from this period as well.
Yeah, it hasn't seen, look, I've not read detailed through the legislation the way that you have, but it certainly hasn't seemed like much of the previous recommendations, certainly not the high level, the big topics. None of those have really been taken on board yet. So,
no, absolutely. Well, this time next week, when we do the SMSF Adviser Show, we, I think, are going to be doing it together at
that is accurate.
The SMSF Adviser Technical Strategy Days.
We will be. We'll be on the floor at the Technical Strategy Day, recording probably in some faraway room that we can get a bit of, avoid some of the noise, but we will be doing it in person at the Technical Strategy Day. It should be great.
Yep. And so Sydney and Brisbane next week and Melbourne the week after. So I think you might have the last sort of chance to register for some of those locations. So yes, you can jump on the SMSF Adviser website to register.
You certainly can, especially if you're wanting to look, if you can't get to the events, as we mention every week. If you can't get there, you can live stream. You can still enjoy all the wonderful sessions.
Absolutely. And the other thing, Keith, was the SMSF Awards. So we did have the finalists announced, and we do have an upcoming virtual event.
We do. We've got the virtual awards event taking place Wednesday, 1st November, 4 p.m. So if you're wanting to see who's going to win, if you are a finalist like Aaron, you will want to be watching.
Absolutely. Well, as is always the way, if anyone has any suggestions on speakers and topics, how can they get in contact with us?
That's right. They can get to us at editor@smsfadvisoronline.com.au and hit us up with everything that they want to hear about.
Excellent. Well, thank you once again for joining us for this week's edition of the SMSF Adviser Show. Have a great rest of the week. We'll catch you soon. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.